Welcome to the deep dive. Today we're jumping into a name many investors know, or should know, Philip A. Fisher.
That's right. We're looking at his ideas specifically through the lens of this book you sent over, the Chinese translation of Paths to Wealth Through Common Stocks.
Yeah, you wanted to, get a quicker but still deep understanding of how he approached growth stock investing.
And that's the goal. It's amazing, really, how much of what Fisher wrote decades ago still resonates, still feels relevant.
It really does. I mean, even Warren Buffett was a huge admirer, called Fisher a great teacher, recommended his books, including this one. That says a lot, doesn't it?
It absolutely does. So, our mission today, if you like, is to unpack Fisher's core ideas. How did he find these growth stocks? What was his method?
Okay, let's get into it. Where do we start? Maybe with the dedication.
Yeah, that's a great place. The book's dedicated to investors who don't just follow the crowd, who reject that, well, everyone believes it, so it must be true kind of thinking.
Right, independent thought. That immediately sets the tone, doesn't it?
It's fundamental to his whole approach.
And that probably connects with why you wanted to look at this getting beyond the surface noise, thinking for yourself. Buffett even mentioned that Fisher helps you avoid that herd mentality trap.
Exactly. Build your own case. And this idea, this need for independent analysis, it really comes through when we look at his first chapter. Inflation is the investor's foe, but also a friend.
Okay, inflation. Now, we need to remember the context here, right? This was written with the 1960s economy in mind.
Definitely. Inflation was a bigger day-to-day concern, perhaps, but the principles, they still apply. He saw it as both a problem and, interestingly, an opportunity.
An opportunity. How so? I mean, inflation usually just eats away at value.
Well, yeah, but Fisher's insight was about which companies could handle it. He noticed that, companies just churning out cheap stuff might seem okay initially,
Right.
but businesses that constantly needed to buy new, expensive equipment, they struggled because replacement costs kept rising.
Ah, I see. So the advantage wasn't just low price, it was efficiency.
Precisely. He argued the companies really focused on, relentlessly cutting production costs, getting more efficient. Those were the ones better positioned. They could navigate inflation, maybe even boost profits.
Okay, that makes sense. Getting more output for less input, basically. And he also saw stocks, common stocks, as a potential hedge against inflation.
Generally, yes. The idea being that owning a piece of a real productive business tends to hold its value better than just cash when prices are rising overall.
But not just any stock, right? He had some nuances there.
Oh, absolutely. He was very clear. Not all stocks are created equal in an inflationary environment. He looked closely at things like dividend yield.
The payout to shareholders.
Yeah, and the stability of a company's earnings, a
Right.
company with consistent growing profits and dividends, much better positioned to maintain its real value than one with, erratic earnings and no payout.
So it required careful selection. Always back to that. The chapter also mentions the rise of big investors back then, mutual funds, pension funds. What was his take?
Yeah, that was a big shift happening in the 50s and 60s. He saw that these large institutions managing more money would likely increase demand for stocks overall, which could push prices up.
Okay, more demand, higher prices. Seems good.
Potentially. But he also flagged a risk. If these big funds started trading aggressively, moving large blocks of stock, well, that could inject more volatility into the market, bigger swings.
All right, a double-edged sword then. More capital, but maybe more instability too. Okay, let's move to chapter 2, how the greatest increases in stock values come about. This sounds like where we get into the core of finding those winners.
This is really central. And what's striking, especially if you're interested in the stuff beyond the raw numbers, is how much weight Fisher put on management.
Oh yeah, I read he thought management quality was something like 90% of the evaluation. Is that right?
That's the figure he's famous for, 90%. It sounds extreme, maybe, but his logic was that truly exceptional leadership is the engine that drives everything else long term.
Wow, 90%. So what was he looking for in these leaders? It wasn't just hitting quarterly numbers, was it?
Not at all. He looked much deeper. Things like absolute integrity, a clear long-term vision for where the company was going,
Okay.
and crucially, the ability to foster innovation, to adapt. He wanted leaders who were smart, strategic, yes, but also ethical and forward-thinking.
He gives an example, doesn't he? Searcy Street, the doctor turned manufacturer.
Yeah, that's a fantastic illustration. Searcy Street. It shows how Fisher looked beyond the obvious. This guy, a doctor, builds a successful metal business.
How did that work? What did Fisher see?
Well, Searcy focused on a niche product, a specialized area. He consistently plowed profits back into the business for growth. And this is key. He built really strong relationships with his workers, good labor relations.
Things that don't necessarily show up on a spreadsheet immediately.
Exactly. And apparently the market was pretty skeptical at first. It wasn't a sexy tech stock or anything.
Right, overlooked.
But that focus, that quality management, it led to huge sustained growth. It proves his point. The best opportunities are often missed by the crowd initially.
And maybe those institutional investors we mentioned earlier might eventually catch on and drive the price up later.
That was part of the dynamic he observed, yeah. Which leads nicely into Chapter 3. You and your investment business must go. This is where he introduces scuttlebutt.
Scuttlebutt. I love that word. Sounds like detective work.
It kind of is. It's all about gathering information actively, going beyond the official company reports, really digging. This speaks directly to wanting that deeper knowledge you mentioned.
So how does it work? He talks about choosing investment advisors in this chapter too. Is that related?
It is, indirectly. His advice on picking advisors sort of reveals his own research standards. He says, look for advisors focused on the long term, understand their philosophy, check their references thoroughly,
Okay.
make sure they seem stable, that they'll be around, and importantly, assess how they help you learn. It mirrors his own thorough, independent approach.
So find advisors who do their homework the way you should be doing your homework.
Yeah.
And the scuttlebutt itself involves talking to people.
Exactly. Talking to customers, talking to suppliers, even competitors, former employees too.
Wow. Okay. Getting perspectives from all angles.
That's the idea. It gives you a much richer, more three-dimensional picture of the company. Its real strengths, its weaknesses, where it stands against rivals. You won't get that just from the annual report.
Like a competitor might give you a very different, maybe more honest take on their technology or market position.
Precisely. Unfiltered views. And Fisher thought this was vital for assessing those long-term prospects and, again, that all-important management quality. How do they really operate? What's the culture like?
You get a feel for the ground truth.
Yeah.
He also mentions different players in finance, bankers, brokers, advisors, and their potential biases, right?
Yeah.
Reinforcing why you need your own research.
Yes, exactly. Everyone has an angle, potentially. Scuttlebutt is about cutting through that.
Okay, so we know how to research, but what are we looking for? This brings us to his famous 15 points, right? They're listed on page 9.
15 points. Yes, his practical checklist for sizing up a potential growth stock. We should definitely touch on a few key ones.
Let's do it. Looking at the list. Point number 5. Does the company have above average profit margins? Why focus on margins?
Good margins are often a sign of, well, a strong business. It suggests they're efficient, they have some pricing power, customers value what they offer. It's a sign of a healthy core.
Makes sense. And point 6 builds on that. What has the company done and what are its plans to maintain or improve profit margins? So it's not static.
Absolutely not. Fisher was always looking ahead. Is management actively working to stay efficient or get more efficient? What's the plan? Past performance is one thing, future strategy is crucial.
Okay. Point 8 is interesting. Does the company have outstanding labor and personnel relations? Why is that on a financial checklist?
It's that management quality thing again, seen from another angle. Fisher believed a happy, respected workforce is a huge asset. It leads to lower turnover, better morale, more productivity, more innovation. It all feeds back into long-term success.
Happy employees, better company. Sounds right. Then point 11, about information. Does the investor have sufficient information? And is he likely to be able to get more? Transparency, basically.
Yeah, transparency and access. You need to be able to understand the business based on available information and trust that you can continue to monitor it. If a company is cagey, secretive, that's a big red flag for Fisher.
Gotcha. And finally, let's look at 13. In the foreseeable future, will the company be able to continue its record of better than average earnings growth? This feels like the heart of it for growth investing.
It really is. Sustainability. Can they keep it up? Fisher wasn't interested in one-hit wonders. He wanted companies with fundamental strengths that could drive superior growth for years to come.
And there are also those 10 don'ts and 8 hints on the next pages, more rules of thumb.
Yeah, more practical wisdom distilled. Worth looking at, sure.
Okay, moving on. Chapter 4, trivia, but not entirely. Sounds intriguing. What's covered here? Mergers and acquisitions.
M&A is one area. And Fisher's take was generally pretty cautious. He saw a lot of potential downsides.
Like paying too much or culture clashes.
Both. Big risks. Overpaying is common. Integrating two different company cultures, different systems, it's often way harder than it looks on paper.
Yeah, I can imagine.
And sometimes the merger can actually distract the acquiring company, dilute its focus, make it less effective. So Fisher stressed really understanding the why. Does this deal genuinely create long-term value? Or is it just empire building?
Good question to ask. The chapter also mentions shareholder voting.
Yeah, he felt shareholders should be informed, engaged. Even if one vote doesn't seem like much, collectively, engaged owners act as a check on management, helping ensure big decisions serve the company's long-term health.
Makes sense. And what about politics? Chapter 4 touches on political influences on the market.
It does. And his advice essentially was, don't get too caught up in it. Focus on the business fundamentals.
Tune out the noise.
Pretty much. Analyze the company's strengths, weaknesses, management, market position. Don't try to predict short-term market swings based on political headlines. Stay impartial. Focus on the underlying business.
Sound advice.
Okay.
Chapter 5. Major growth industries of the 1960s. Obviously, the specifics are dated, but what's the underlying principle?
Right. He talks about things like, I think, the office equipment industry back then, but the core idea is timeless. Identify broad sectors with major long-term growth potential.
Secular trends.
Exactly. Big shifts in technology, society, the economy that will drive growth for years, maybe decades. Think about renewable energy today, or AI, or certain areas of biotech. Those kinds of big picture trends.
So find the wave, then find the best surfers.
That's a good way to put it. Because just finding the growth industry isn't enough. You still have to do the hard work, the scuttlebutt, to figure out which companies within that sector are best positioned to really capitalize on the trend and become leaders.
It always comes back to that deep research on specific companies, doesn't it?
Always. Industry trends provide context, but the investment decision is about the individual business.
Okay, so if we were to sort of boil down Fisher's whole approach, what are the absolute must-remember takeaways for someone listening?
I'd say number one, thorough, almost obsessive research, really digging deep. Scuttlebutt. Number two, that huge emphasis on management quality, integrity, and long-term vision.
The 90% factor.
Yeah. And number three, a genuine long-term perspective. He wasn't about quick flips. And underpinning it all is that commitment to independent thinking. Don't just follow the herd.
That seems like a really solid framework, especially for someone wanting to build real understanding, not just chase tips.
Absolutely. It's a methodology for informed decisions.
Okay, so maybe a final thought to leave people with. Building on Fisher.
Well, thinking about today, we're drowning in information, right? News, data, social media opinions, constant noise.
Definitely.
So maybe Fisher's emphasis on qualitative research, on actually talking to people, that's scuttlebutt. Maybe it's even more important now. How do you cut through all that digital noise to find the real story, the ground truth about a company?
How do you apply scuttlebutt in the internet age? That's a great question. It requires real effort, doesn't it?
It does. But Fisher would argue it's worth it.
A powerful thought to ponder. We definitely encourage everyone to check out the book, La Benya, for the full picture. Philip Fisher's ideas offer so much. Thanks for joining us for this deep dive.